Behavioral finance combines insights from psychology and economics to understand how individuals make financial decisions. Traditional finance theories, such as the efficient market hypothesis, EMH, assume that investors are rational and markets are efficient. However, real-world observations reveal that investors often behave irrationally, driven by emotions and cognitive biases. Behavioral finance seeks to explain these deviations and their impact on financial markets. Common psychological biases. Several psychological biases frequently influence investor behavior. Overconfidence bias. Investors often overestimate their knowledge and abilities, leading to excessive trading and risk-taking. Anchoring bias. This occurs when investors rely too heavily on the first piece of information they encounter, the anchor, when making decisions. Herd behavior. Investors tend to follow the crowd, buying or selling assets based on the actions of others rather than their own analysis. Loss aversion. The pain of losses is felt more acutely than the pleasure of gains, causing investors to hold onto losing investments for too long or sell winning investments prematurely. Confirmation bias. Investors seek out information that confirms their existing beliefs and ignore contradictory evidence. Recency bias. Recent events are given more weight in decision-making than long-term trends, leading to an overemphasis on short-term performance. Impact of psychological biases on investment decisions. Psychological biases can significantly impact investment decisions and market outcomes. Market volatility. Herd behavior and overconfidence can lead to market bubbles and crashes as investors collectively drive prices away from their fundamental values. Poor portfolio performance. Biases such as loss aversion and anchoring can result in suboptimal portfolio management, leading to lower returns and higher risks. Mispricing of assets. Confirmation bias and recency bias can cause investors to misprice assets, creating opportunities for arbitrage and leading to inefficiencies in the market. Strategies to mitigate psychological biases. Investors can adopt several strategies to mitigate the impact of psychological biases on their decision-making, education, and awareness. Understanding common biases and their effects is the first step towards mitigating their impact.